All right, everyone, welcome to your high-impact revision on depreciation. I know this can be a really tricky PGBP topic, but trust me, in the next few minutes, we are going to absolutely master it. My goal here is to give you the confidence to walk into that exam and tackle any question they throw at you. Okay, so here's our game plan. We're going to start with the basic framework, get that solid. Then we'll nail down how to calculate actual cost. Super important. After that, we move to a real scoring area, additional depreciation. Then we'll tackle that infamous 180 days trap. And finally, we'll put it all into practice with an exam-style problem. Let's get right into it. First up, the depreciation framework. Seriously, if you get this foundation right, every single calculation that follows becomes so much easier. Let's lock this in. Okay, first thing you have to burn into your memory, under the Income Tax Act, we do not calculate depreciation on individual assets. We group them together into what's called a block of assets. So all your plant and machinery at a 15% rate goes into one bucket. All your furniture at 10% goes into another. This is a fundamental concept. You have to get this. Now, this four-step WDV formula, this is the engine for every single depreciation problem you will ever see. You start with the opening WDV, you add the cost of new assets, you subtract any money from sales, and that gives you your closing WDV. This sequence is absolutely non-negotiable. So why does this matter in the exam? Simple. You get this formula wrong, and your entire answer collapses. It's the very first domino to fall. All right, next up, calculating actual cost. Remember step 2 in our formula? This is it. And if you get this number wrong, it's going to cost you marks all the way through your answer. So let's make sure we get it right. Okay, I need your complete attention for this next part. Please listen carefully, because this is where most students make mistakes. Examiners just love to hide little traps inside the actual cost calculation. But don't worry, we're going to spot them every single time. So here's the deal. Actual cost is not just the price on the invoice. First, you have to reduce any subsidy you received for it. And second, this is the big one, you must exclude any payment over 10,000 rupees made in cash in a single day. The government's trying to push for banked transactions, right? So, quick recap. Cost minus subsidy minus any cash payments over 10,000. Why does this matter? Because examiners use these tiny adjustments to test your attention to detail. Nailing this puts you way ahead of the curve. Now for a topic that can seriously boost your score. Additional depreciation. This is a scoring area you cannot afford to skip it. I know a lot of students find it confusing, but it's actually pretty straightforward and offers easy marks if you just know the rules. The rate? It's a flat 20%. Just think of it like a bonus deduction for investing in your business. It's extra depreciation on top of your normal depreciation on the actual cost of new eligible plant and machinery. The whole point is to incentivize businesses to modernize and expand their manufacturing base. So, who gets this bonus? It's for businesses that are actually into manufacturing or production. And the key conditions you have to look for are that the asset has to be new plant and machinery. It absolutely cannot be secondhand. And remember, the law specifically includes businesses involved in printing and publishing too. Now pay very close attention to these exclusions. They are classic exam traps. Additional depreciation is not allowed on secondhand assets. It's also not allowed for assets you install in your office, like computers or air conditioners, even if they're brand new. And finally, you can't double dip. If you've already claimed a 100% deduction for something, you can't claim this too. So let's recap. No secondhand, no office assets. Why it matters? Spotting these ineligible assets is the absolute key to getting the additional depreciation calculation correct. Okay, let's tackle the one rule that really separates the top scorers from everyone else, the 180 days trap. This is, without a doubt, the single most important rule to apply correctly in any depreciation question. The rule itself is pretty simple. If a new asset is put to use for 180 days or more in the year you buy it, you get the full depreciation rate. But, and this is the key part, if it's put to use for less than 180 days, you only get half, just 50% of the normal rate for that year. And remember, the deciding factor is the put-to-use date, not when you bought it. And here it is, the absolute crucial point that you cannot forget. That 50% rate reduction applies to both normal depreciation and additional depreciation. So your normal rate gets halved and your additional rate gets halved from 20% down to 10%. Why does this matter so much? This is the most common and the most costly mistake students make. Applying that half rate to both can literally be the difference between a pass and fail on a question. always double check this. Okay, enough theory. Let's apply all of this to an exam-style problem and see exactly how these pieces all fit together. So here's our situation. We've got a manufacturing business. You see the opening WDV and the 3 new assets they bought. The first thing I want you to do is look at those put-to-use dates. The first machine, June. Well, that's way more than 180 days. The second machine in December and the office computer in January. Both of those are going to fall under our less than 180 days rule. Okay, let's break this down carefully. First, normal depreciation on plant and machinery. The assets used for more than 180 days are the opening WDV of 30 lakhs plus that first new machine of 20 lakhs. So on that total of 50 lakhs, we apply the full 15% rate, giving us 7,50,000. Simple. Next, the machine used for less than 180 days, worth 8 lakhs. On this, we have to apply half the rate, so 7.5%, which gives us 60,000. Now for additional depreciation. This only applies to the new machines. The 20 lakh machine gets the full 20% bonus, which is 4 lakhs, but the 8 lakh machine was used for less than 180 days, so it only gets half the rate, 10%, which is 80,000. Finally, the computer. It's in its own separate 40% block. Since it was used for less than 180 days, we apply half the rate, 20%, on 3 lakhs, giving us 60,000. Now, is it eligible for additional depreciation? No, absolutely not. Why? Remember the rule. Assets installed in the office are excluded. See how every single rule we just talked about comes together right here?
So, before you walk into that exam hall, this is your final mental checklist. First, always check the put-to-use date for the 180-day rule. Second, look closely at how assets were paid for. That 10,000 rupee cash limit is a favorite trap. Third, be a hawk about the exclusions for additional depreciation, especially office equipment. And finally, just follow the logical flow. WDV first, then normal depreciation, and only then additional depreciation.
And there you have it, a complete point-by-point breakdown of one of PGB's most crucial topics. You now have the tools, you have the structure to confidently solve any depreciation problem they can come up with. You've totally got this. So, which topic are you going to conquer next? Keep that momentum going.